covered call is a very famous strategy that a lot of people use. It's one of the strategies that most people are using the first time when they get into options, and there's a lot of questions around the covered call strategy. And one of them is, which expiration should you choose? Should you go for a weekly expiration or should you go for monthly expiration? And in this video, we're going to compare the weekly expirations compared to the monthly expirations and see if there is one that is more profitable than the other. So hopefully when you use that strategy, you really make the most out of it. But before diving into this video, if you find this video interesting, you like the fact that I compare some strategies or some expirations, and you like to see more videos like this one, then just subscribe to my channel and like this video. That's the best way to let me know that you like to see more videos like this one. So before going into really the comparison between, weekly expirations and monthly expirations and see which one is the most profitable, I'm going to do a small reminder of what is the covered call strategy. If you already know what it is, just don't hesitate to skip that part. I'll put some timestamps in the description of the video so you can easily skip that part if you already know what it is. But first of all, for those who wouldn't know what is that strategy, what is a covered call? A covered call is a strategy that a lot of investors tend to use, and that's usually actually one of the first strategies that people tend to use because it's actually quite a simple strategy, quite simple to understand and quite simple to execute also. The covered call strategy consists in buying 100 shares of a stock and then selling a call against it. And ideally, you want to sell an equivalent amount of calls compared to how many shares you have bought. In other words, it means that if you have bought 100 shares, then you should sell one call because one option controls 100 shares. So if you buy 100 shares, then you want to sell one call. If you bought 200 shares, then you want to sell two calls. You want to do the equivalent. But why would you do that? Why would you want to use the covered call strategy in the first place? Well, let's imagine that, for example, you bought 100 shares of, let's say, the SPY. The SPY is the S&P 500 ETF. But you think that the SPY is going to go down in the next days, in the next weeks, and instead of just seeing your shares losing value, you also want to take advantage of that down move. And to take advantage of that down move, you could do what we call sell a call. By selling a call, you're going to take advantage of a down move, because when you sell a call, you're bearish. You want the stock to go down. If the stock goes down, then it means that your call is going to lose value, which is exactly what you want. When you sell an option, you want that option to decrease in value so you can buy it back at a lower price. That's why if you think that the stock is going down, by selling a call and the stock actually goes down, your call is going to lose value, which is exactly what you want because it's going to bring you profit. And usually people tend to use that strategy when they already have a portfolio of different stocks, they have plenty of shares, and they want to hedge themselves against a potential down move. So they're going to sell calls against their shares so as to take advantage of that and make money even though their stock is going down. That's why you would use a covered call. So that's it for the covered call strategy. Now we've done a small reminder of what is the covered call strategy, but now the big question, what is the matter with all those expirations? Why are we talking about weeklies or monthlies? Well, the thing is, whenever you trade options, either you buy options or you sell options, you have to choose an expiration. You cannot just sell an option like this. You need to choose an expiration, and you have plenty of choices. You could sell, for example, an option that is expiring in a week, or for example in 2 weeks, or even a year. I mean, it's really up to you. And because of that, because you have so many different expirations that you could potentially choose, for example, when doing the covered call strategy, it raises the question, which one is the best expiration? Is there a better expiration that you should go for? And usually there is a big debate, because is it better to go for weekly expiration, meaning is it better to sell a call on an expiration that is going to expire, let's say, in 6 days or 7 days, or is it better to sell a call, for example, that is going to expire in 30 days? Usually there is quite a big debate between weekly expiration and monthly expiration, and that's why I wanted to clarify in this video. And to fully see the differences and try to see which one is the most profitable, I'm going to go with an example of the SPY, the S&P 500 ETF, and pretend as if we were going to do a covered call on the SPY so it's completely clear. So right now I'm in the Testworks platform, and you can see at the top that I have the SPY. So I'm in front of the option chain for the SPY, and as you can see, there are plenty of expirations that you could choose. There are literally, I don't know how many expirations there are probably like around 20 or 30 different expirations that you could choose. So which one should you choose? Well, in that case, we're going, for example, to compare an expiration that is going to expire, let's say, in 6 days, like this one that I have within this yellow rectangle, and I'm going to compare a monthly expiration, for example, the May 21 expiration. So we're going to compare those two expirations. The first one, April 23 expiration, is going to expire in 6 days, and the second one, the May 21 expiration, is going to expire in 34 days. So now we have this weekly expiration versus monthly expiration, and we're going to see which one is the most profitable. And by the way, I talk a lot about the SPY, meaning the S&P 500 ETF, because it's considered as the benchmark. That's usually what we compare our performances against. That's why I'm using the SPY as an example here, because it's referred as the benchmark, and I want it to be like quite a general example on which you can base yourself on for the future. So that's why I'm going for the SPY. But to make that experiment, to make that comparison quite relevant, we're going to have to compare apples to apples, because otherwise it doesn't make sense. And to try to compare apples to apples, we're going to go look for the delta. And for those who don't know what the delta is, the delta refers to the Greek letter, and in options it means how much value the option is going to take if the stock is gaining, for example, $1 or losing $1. And the good thing about the delta is that it's very often used as the way to quickly know the probability of profit for a trade. In other words, if you go for the option, for example, that has a delta of 30, it means that the option roughly has a probability of expiring in the money of 30%. And because it has approximately a probability of expiring in the money of 30%, then it means that it has a probability of expiring at the money of 70%. So I'm going to compare the two options that have the 30 delta in both expiration, in the weekly expiration and in the monthly expiration, so we can compare apples to apples. So right now we are in the weekly expiration. You see that at the top there is April 23, 2021. It's an expiration, it's a weekly expiration, and it's expiring in 6 days. And if we go for the 30 delta that I just talked about before, then you can see that I have set up this column, and you can see within the yellow rectangle. And if we go for the 30 delta, it means that we're going to go for the 420 strike within that yellow rectangle. You see, it's a 29, and it can roughly be like 30 delta. There is no closer to 30 delta than this, so I'm going to go for the 29 delta, and that's the 420 strike. If I click on selling that 30 delta option, you see that I could make a max profit of $102, meaning that if the call option that I'm going to sell right now expires at the money, it means that I'm going to make a max profit of $102 if the option expires at the money. So that's for the weekly expiration, meaning that if you sell a call in that expiration that is expiring in 6 days, then you're going to make $102 of potential maximum profits. Now, let's switch onto the monthly expiration to see the difference compared to the weekly expiration. Now we are in the monthly expiration, as you can see at the top. Now it's the expiration May 21, 2021. You see that expiring in 34 days. If once again we go for the 30 delta strike, then in that case it would mean that we're going to go, let's say, for the 425 strike. You see that the delta, once again in the left column, is at 31. That's the closest to the 30 delta. You can see that if I decide to sell that call option, now I'm going to earn a potential max profit of $293, a lot more than the weekly expiration. However, and that's where it really gets interesting. Obviously, you saw that in the first example with the weekly expiration, I was going to make around $102 maximum profit, and the expiration is in just 6 days. Compared to this expiration, the May 21, 2021 expiration, where I would make a potential max profit of $293. However, you can see that technically, if I was repeating that action on the weekly expiration, meaning that if I was selling that weekly expiration, then in 6 days it expires, and then I sell another one again and make a potential max profit of $102. If I was doing this week after week after week, then after 4 weeks, I would make, let's say, around $400 worth of potential profit, compared to that monthly expiration where I would only make $293 of potential profits. So you see that if I was repeating actually that weekly expiration week after week, I would end up with more money in the end compared to if I was selling that monthly expiration. But what's the catch? Because obviously you can see that it's more profitable if you just like sell week after week after week, meaning that you would end up with more money if you were right all of the time. Let's imagine that you were right all of the time. You'd make more money by selling those weekly expirations. Let's say you sell this weekly expiration, and then when it expires, you sell another one again, and then you sell another one again, and so on and so on. After a month, you would end up with more money than if you were selling that monthly expiration directly that is expiring in 34 days. Well, as much as there is not necessarily a catch per se, meaning that there is no trap necessarily, there are some big differences between selling a call in a weekly expiration compared to selling a call in a monthly expiration, or at least an expiration that has more days in front of you. The first point that I'd like to cover is about the liquidity. What is the liquidity? Well, it just means how how many people are actually trading that option. Usually, weekly options tend to have less liquidity than monthly expirations. It means that if you try to get into the trade and get out of a trade with your profits, and that's usually the most important thing, you're usually going to have more troubles with weekly options compared to monthly options because there are just less people trading them. So you have less chances of meeting someone on the other side of the trade willing, for example, to buy back or sell you that option that you're trying to do at that specific price. And compared to monthly expirations, where usually there tend to be a lot more people trading them, and so you're going to have better prices, you're going to be filled at better prices. And that thing can really change a lot, because as much as getting into the trade is not necessarily an issue, getting out of a trade with your profits is a lot harder when there is a lot less liquidity. And I can tell you that from experience, you don't want to find yourself in a trade where there is no liquidity. And that happened to me where I was in a trade where basically, and that was at the very beginning when I was trading options, I was in a trade and I wanted to get out of my trade, except that I didn't check the liquidity beforehand. And what happened is I couldn't get out of a trade. I couldn't get out of the trade, and actually the trade went against me. And it went against me, and now I was stuck in a trade with a loss, and I couldn't take actually even my loss. I couldn't even take my loss. That was a very big problem, and that's where I realized that liquidity is really key. And to help you, you should always try to check the liquidity before taking a trade. And for that, I use the open interest. The open interest refers to how many contracts are currently held right now for that particular option. In other words, the higher the open interest, the more liquid the option, and vice versa. The lower the open interest, the less liquid the option. So ideally, you want to focus on options that have high open interest. And what does that mean, high? Well, usually you're going to see, for example, for the SPY or for any other well-known stocks, that monthly expirations tend to have like thousands and thousands of open interest for each and every single option, compared to weekly expiration, where it tends to have a lot less liquidity. So I'd say that any option that has less than 200 in terms of open interest is usually a no-go for me, because there's no point for me in trading an option that is illiquid. Because as I said, as much as there's not necessarily a lot of troubles getting in, getting out with your profits is the most important thing. So what's the point of trading an illiquid option? And now I'm back in the test work platform, and I want to show you the open interest visually, so it's actually quite clear for you. You can see that I have a column that is within that yellow rectangle, where this is the open interest, meaning that you can see for each and every single strike for those options, and you can see also it's on the put side, you can see the different open interest. So you can see that for the SPY, and know that it's the ETF that is the most traded in the world, so obviously it's very liquid, but you can see that for each and every single option there are thousands and thousands of open interest. And now I went into the weekly expiration, so obviously because it's the SPY, my example doesn't really work because there's just so much liquidity for that particular ETF. However, you will see that usually with stocks, other stocks in general, like weekly expirations tend to have less liquidity, and the open interest is really something that you should check before taking the trade. And liquidity can really be impacting your trading, because yes, it's great to have a potential profit that is a lot bigger than the monthly expiration. It's great. However, if you're not able to get into the trade and get out of the trade with your profits, that big potential profit doesn't really mean anything. That's why I said that you need to be careful about liquidity, because weeklies tend to have less liquidity. Now, the second big difference between weekly expirations compared to monthly expirations, and regardless of the profit, is about what we call the gamma risk. So that sounds like a very fancy risk or whatever it is, but you're going to see that it makes sense and it can be very clear, and let me explain it to you. Gamma is a Greek letter, and actually is what we call a second order Greek, meaning that you have the first order Greeks for options, there are delta, there are vega, there are theta, and then you have the second order Greeks. And those second order Greeks, depending on how far or how close you are to expiration, they're going to impact a lot the option price. And stay with me if you still don't get it. I'm going to give you an analogy so it's completely clear. And to understand that gamma risk, we just need to understand what makes an option price in the first place. You can mainly sum up what makes an option price. Let's say that you saw that you were potentially making $100 on that weekly expiration. What makes that $100? There are basically three factors. There's the stock price, meaning that depending on where the stock moves, the option is going to take more or less value. That's something that everyone can pretty much understand. Then there is the implied volatility. In other words, the demand for that option. For example, if a lot of people at once are willing to buy the exact same option, what's happening to the price of that option? Well, it's going to increase. That's supply and demand. And vice versa. If no one is willing to buy an option anymore, then the price of that option is going to decrease because now there's less demand for it. And that's the implied volatility, and that's the second factor that makes an option price. And the third factor is the time decay, because every day that passes, options tend to lose a tiny bit of value. And the closer we get to expiration, the bigger the amount that they lose on a daily basis. And all of this together, it's like you shake it and then it gives you the option price. And now that we understand this, now that we understand that there are those three main factors that make the option price, and on top of having those different factors, there is something that is so crucial to understand. Depending on how close or how far you are to expiration, those three factors are going to play a smaller or bigger role in the option price. And let me give you an analogy so it's completely clear. Imagine that it's like a scale where you have those three factors. Depending on how close or how far you are to expiration, those factors are going to have more or less weight in the scale, and so impacting more or less the option. And that's really like the best way I can put it. If you are very far to expiration, the stock price is going to have less weight in the scale. It's going to impact less the option price, where compared to if you're closer to expiration, where the stock price is going to affect a lot more the option price. And depending on how close or how far you are from expiration, those three factors are going to play a bigger or smaller role in the scale. If you're far to expiration, usually the stock price is not going to play as big of a role in the option price. It's more going to be the implied volatility that is going to have a bigger weight in the scale. And the closer you get to expiration, the more the option price is going to be relying on the stock price and on the time decay. The time decay is getting bigger and bigger as the expiration is coming closer and closer, and the stock price is going to have more and more weight in the balance, influencing the option price a lot more when you get closer to expiration. And the implied volatility, as you get closer to expiration, is not going to play that big of a role when it's very close to expiration. It's more going to be the stock price that is going to impact a lot the option price. I hope it made sense. I don't know if it was a crap analogy or if it was a good one. Let me know in the comment section if you have any question about this, but that's really the best way I can put it. And as I said, the closer you are to expiration, the more the option price is going to rely on the stock price movements. And that leads me to talk about the gamma risk, what I was talking about before, because that weight in the scale is literally called gamma. It's that second order Greek, and we call that gamma because that's literally taking back that analogy of the scale. Like if you're close to expiration, the stock price is going to have a lot more weight in the scale, and that's gamma basically. That's the sensitivity of the stock price on the option price. And what does that mean in simple terms? Well, it means that the closer you are to expiration, the more the option price is going to depend on the stock movements. So what does that mean for our case of weekly versus monthly expiration? Well, it means that when you're going for weekly expiration, it means that the stock price is going to affect a lot your P&L. Compared to if you go for monthly expiration, that is a lot further away in time, then the stock price is going to play less of a role in the option price. The option price is going to be more dependent on the implied volatility when it's very far away from expiration, compared to when it's very close, where the implied volatility is going to play less of a role, and it's more going to be the stock price that is going to affect a lot the option price. And that's why we call that the gamma risk, because when you're very close to expiration, the option price is going to be really affected a lot by the stock price movements. And for example, let's say that you sell a call in a weekly expiration that is expiring in 6 days and a crash happens. Well, you're going to be in a very bad situation because the stock price movements are going to affect a lot the option price. And so you're going to be in a very big loss because you're so sensitive to the stock's movement that if there is a crash, you're going to have a huge running loss. Compared to someone who would have gone for a monthly expiration, where the gamma risk isn't really as big as compared to when it's close to expiration. If you had gone for the monthly expiration and there was a crash happening, you would be in a smaller running loss compared to someone who would have gone for weekly expiration. I hope it makes sense. In other words, the closer you are to expiration, the more volatile your P&L is going to be because it's going to be more dependent on the stock price movements. So is it a bad thing? Is it bad that the option price is going to be dependent a lot on the stock movement when you're close to expiration? Well, it's not necessarily a bad thing per se. However, you need to be aware of those differences between going between a weekly expiration and going for monthly expiration. There's not necessarily a good or bad choice between going for weekly versus a monthly expiration. However, there are some big differences differences, as I said before, in terms of liquidity, gamma risk, and you need to take those into account before taking a trade, so you go into the trade knowing what you do basically. And personally, I can tell you that even though, yes, there is more of a gamma risk going for weekly expirations, if I, for example, sell covered calls, I'm going to tend to go for weekly expirations, because if you compare the premium that you receive when you're trading weekly expirations compared to monthly expirations, I personally tend to make more money trading weekly expirations compared to monthly expirations, because as you saw with our previous example, you make more money if you repeat that action on a weekly basis compared to selling a call in a monthly expiration. So if I had to choose a team, I would probably go for the weekly expiration team and not go for the monthly expiration team. Even though there would be more volatility in the P&L because of the stock price movements, because I'm going to make more, I'd rather go for weekly expiration to make more the risk worth taking. But that's really only my opinion. So those are really the big differences between the weekly expiration and the monthly expiration. And as I said, it's so important to understand what you're doing before getting into the trade, so you don't find yourself in a bad situation and you don't know what's happening. At least if you find yourself in a big running loss, you know why. I hope you enjoyed this video where I tried to show you the differences between the weeklies and the monthly expirations, and I hope you found it interesting. If you liked it, don't hesitate to subscribe to my channel and like this video. That's really the best support you can give me. And if you want to watch more videos like this one, just let me know by subscribing to my channel. That's really the best way to let me know that you actually like that video. If you have any question, as always, just don't hesitate to put it down below. I'll be happy to answer any question that you might have. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.